All right. Good afternoon, everyone. It is 3 o'clock Eastern. This is Rich Swerbinsky with the Mortgage Collaborative, and want to thank everyone for joining us for the maiden voyage of the Rundown with Rob and Rich. Yeah, this is just Rob and I did a session at our 12 days event that we got a lot of nice comments about, and several people mentioned like you should make that a recurring thing. And that's typically how we form ideas at the Mortgage Collaborative. People give them to us and we're like, oh, you know what? That's a good idea. So here we are. And we're going to do this every other Friday. And anybody that knows Rob or I knows we will not be taking ourselves too seriously and be taking a very lighthearted look at everything and anything that's going on in the mortgage industry and potentially other industries as well. But Rob, thank you for joining us. Happy New Year.
Happy New Year,
You're
Rich.
Lake Tahoe. You're right outside Lake Tahoe, right?
Yeah. Yep.
You weren't involved in that storming of the Capitol. I saw something on camera. That wasn't you, right?
Boy, getting into politics right away, are we, Rich? No, I haven't been. I haven't been west or east of the Mississippi since for almost a year. Yikes. Anyway, no, that wasn't me.
And you were in San Fran. You lived in San Fran kind of as your primary home, but then you moved to Nevada a couple of years ago, right?
Yep. Yep.
So, and that's where you've been quarantining?
Yeah. Northern California, Nevada, kind of moving around a little bit. Quarantine is an interesting concept. I think it tends to expand or contract a little bit depending on people and depending on time. So, but yeah, most of the time has been here. Although I did spend a little bit of time in Hawaii about a month ago, which was interesting because if you look at COVID numbers, the Hawaiian numbers are actually better than California's. California's been in a tough spot here in the last couple months. So, but yeah, pretty much staying close to home. What about you?
I live in a suburb like 20 minutes outside Cleveland, Ohio. And like our team, we've always worked from home, really, the 6 years I've been with TMC. So hasn't been a big adjustment for us. It's like we never did Zoom calls, though, until 8 months ago for some reason. Like, why were we not doing that? The technology existed. So we've evolved, I think, with everyone else here. But yeah, I've just been spending a lot of time at home, trying to stay active, trail the hikes and chasing my dog around. And it's been nice not traveling, although now I'm starting to get the itch again with the Cleveland winter upon us. So
Yeah, I tell people, they ask because I did some traveling, and people ask if I miss it, and I don't miss the travel itself. I miss the events and the people I would get to see and meet when I got to wherever I was going. I miss that, and I think a lot of people in the industry miss that. It's not so much getting to the airport an hour early and taking an Uber to the embassy suites or whatever. It's the seeing somebody from across the room and waving and going and saying hi and saying how's it going, or talking to people in the hallway that you happen to see. So I think that's what people do miss in our industry.
absolutely. Yeah. I think it's such a human business. I mean, it really is. I mean, this is really as much as technology evolves. This is so much a like sit across the table and, meet with several people in one day in person over meals and cocktails type of business. And yeah, definitely some pent up demand. So I see we've had a bunch more people join us. This is the Rundown with Rob and Rich, which we're going to do every other Friday at 3 p.m. Eastern. Rob and I just kind of taking a lighthearted look at everything that's going on inside and around the mortgage industry, and no rules to this thing. So definitely strive for interactivity. Any questions, comments, jokes, blackmail you have on Rob that you want to present or throw out there in the chat or the Q&A, please just feel free to do that, and we'll incorporate it into what we're talking about. So, but Rob, a lot going on politically now. Obviously, we got a new administration coming in 5 days, barring some other sort of insane transgression of events. And one of the things that's starting to become apparent is like, head of CFPB and head of FHFA, probably not long for the world. I don't think you're on LinkedIn very frequently, but I proposed you for the head of the FHFA this morning. I have 16,000 connections on LinkedIn, 32 liked it. So at least 0.2% of our sphere thinks it's a great idea. So address the rumors.
FHF, I barely know what FHFA stands for, Rich, and I even have trouble saying it. It's so much easier to say FHA rather than FHFA. Uh, there are, yeah, with the change in administration, I'll tell you there's a lot of chatter out there. There's a lot of things that people are talking about leading up to the election in early November, because it's been a couple months already since the election. There was a lot of uncertainty, and I always make fun of people when they talk about uncertainty. Uncertainty. What I'm going to have for lunch tomorrow is uncertain. There's always uncertainty with regard to the future, and with the change in administration, the election didn't determine anything right away. It took a while for people to accept that we'll have a new president and some new senators and some new people in the House of Representatives. So there is some uncertainty there, but I think that what the experts have said is that the Biden administration will be making some changes eventually. Now, what I think people on the call should remember is that every transition of this size and magnitude takes time, takes months and months. And this transition has been interesting, to say the least. Whether you're Republican or Democrat, the transition this time around has been a rocky situation. And so it may take longer on the backside than other transitions. So the general feeling is we're not going to see a huge change right away, whether you are looking at interest rates, whether you're looking at the regulatory environment, whether you're looking at Fannie Mae or Freddie Mac or FHA. We'll see some changes certainly over time, but it's not like somebody's going to flip a switch on January 21st and suddenly we'll have a new head of the CFPB and a new head of this and a new head of that. And so, it'll take a while. And I think that certainly the regulatory environment will change. The volumes, to take a step and look at something near and dear to a lot of people on the calls, in their minds, is volume estimates for 2021. And the fact of the matter is, the Federal Reserve, who doesn't set mortgage rates, has pretty much said that they are going to maintain the status quo in terms of overnight Fed funds, discount rate, prime rate. Look for those not to be changed much at all, and perhaps for the remainder of 2021. But you're going to have refi burnout, and that's what a lot of people are focused on that I talk to is, all right, what's going to happen here? Rates have been, near 3% for quite some time. You can only refinance somebody so many times, or down to 3%, and then they're kind of done. And so what the owners and CEOs that I talk to on a regular basis are concerned with is the drop off in refi volume. And in fact, if you look at the MBA's numbers and Fannie Mae's numbers and Freddie Mac's numbers, there's some wild estimates, but on average, they are looking for refis to be down about 62% in 2021 versus 2020. Now, on the positive side, they're looking for purchases to be up about 10%. But the overall volume that they are estimating, and I have my thoughts on estimating anything in forecasts, but they are estimating industry-wide volume to be down about 22%. And that is a concern for lenders who, we've had a head start heading into 2021. Pipelines were really good all through the second half of 2020 and into 2021. Pipelines are full. Loans are being sold and funded. And so we have a little bit of a head start. So it'll be interesting to see what happens as we get into springtime and into summer, the traditional purchase season, whether these low rates which many people think will be with us for a while. Whether they stick around, I think they will. I don't see any big reason for rates to go up. But you get into refi burnout, and we'll see what happens. So that's an issue that's on a lot of people's minds right now, is what's going to happen to volumes, what's going to happen to the people that we're hiring now. We're staffing up, we're trying to get people on board to process and fund these loans that are out there, especially on the refi side. So, managers will have to be managing, certainly, as we move through 2021, just not hiring and hiring and hiring. It's going to be hiring and selectively keeping if volumes do drop off.
Yeah, it's going to be interesting, as you noted. I mean, depending on which economist you look at, they're predicting somewhere between a 20 and 26% overall drop in total originations for this year. Yet, I mean, we just went through a wave of collaboration labs with close to 100 of our lender members that, they're obviously talking about volume projections for next year. Just my day-to-day talks with CEOs and heads of our member companies, I don't think I've heard anybody predict for their company a 25% drop off for next year. And part of
No,
that's the industry, right? I mean, but it seems like there is a little bit of a disconnect, more so than normal, between the economists and the people running the business.
right. Oh yeah. It's always, I liken it to, you're in a landing craft approaching the beach at Normandy or Iwo Jima, and they've talked about casualty rates, and it's not, the guy to my left, he's going to get injured, and the guy to my right, he'll probably get killed, but I'm going to be fine. And that's kind of the mentality that a lot of lenders have, that the industry itself continues to be saved through a lot of thick and thin. And it could be a situation where you get into a market share grab from your friendly competitors. And for the benefit of a lot of small and mid-sized independents, the big banks have been losing market share for a while now. And if you're Wells Fargo and you lose a little bit of market share, your lost market share can make a great year for a lot of lenders that are out there to divvy that up. So yeah, it'll be interesting to see. Nobody thinks they're going to be killed on the beach in Normandy, and nobody thinks their volumes are going to go down, because we're going to add branches, and we're going to add loan officers, and we're going to do this, and we're going to do that. So once again, it'll be interesting.
For those just joining us, Rich Swerbinsky with the Mortgage Collaborative, here with the one and only Rob Chrisman with the Rundown with Rob and Rich. We're going to be doing this every other Friday at 3 p.m. Eastern. And yeah, would be interested for any of you that are watching the webcast, in the chat, your thoughts on just volume. You can send them privately to me if you don't want to put them out there publicly. Your thoughts on what volume will look like all in all total this year, just the total pie. Again, most of the most noted economists predicting, about a 22% drop off here as we move into next year. Refi is down 50 to 65%, purchases up 8 to 12%. And all in all, a drop of about a quarter of the total volume. So, the other thing that I just think is interesting, so, the regulatory piece of it, I saw a comment from Sherrod Brown, my senator here in Ohio, who's set to take over as the chair of the Senate Banking Committee. My previous life as a community banker, through DC Fly-ins, had some interaction with him. I think to some degree he gets somewhat of a bad rap. But I think that is because of some of the things that happened to community banks in the wake of 07 and 08, some of the unintended consequences from some of that regulation. But the one comment I saw that this is a near direct quote. It was, Director Kraninger should be updating her resume and looking for new employment. Like, he just came out and said that about the CFPB's director, Kathy Kraninger. Now, and that the Supreme Court, I think, ruled last year that the president can just make that, they can change that out, I think, without getting that, having it have to go through Congress, if I'm not mistaken. No, isn't that the change that we saw a year ago?
Correct. I'm not exactly sure of the exact nomination and approval process, but uh, it is too bad because if you look at Richard Cordray's administration of the CFPB as it was getting started and as it developed, went into adolescence or the teen years, whatever you want to call it, he promoted a very arrogant attitude with the CFPB. Shoot first, ask questions later, going after the big enforcement actions and grabbing the headlines and so forth, and really kind of elbowing his way into the regulatory environment. That changed with the current administration and the current director. And I say it's unfortunate because so many people have really appreciated the job that she has done in terms of the CFPB. It's not the hooded executioner knocking on your door kind of situation. It's been far more educational to the industry. Yes, it continues to help consumers on a variety of levels, just not mortgage, but car loans and all kinds of finance situations. But what the CFPB has done is made themselves more educational, more user friendly, and sent Mark McCardle out, for example, to speak at different events and talk about what the CFPB is doing and incorporating what the industry is suggesting. So you have that on one hand, and you also have a situation, Rich, that I think a lot of people on the call need to remember, and that is we are a much more compliant industry than we were 10 or 12 years ago. The borrowers have to meet the ability to repay. The MSAs have been reined in. LO comp has been set forth. And yeah, there are some questions regarding MSAs and LO comp and other issues, but I think the CFPB is looking at us as an industry that doesn't need fixing as much as we did 8 or 10 years ago. It's looking at us as an industry that has changed. We are much more cognizant of what the consumer needs. Servicers are much more, have the ability or can deal with their portfolio in a much more regulatory friendly way. I mean, it's been spelled out, and the companies that are around now, I don't hear people, I don't receive emails from people saying, oh, ABC, they've got a point bank, or they're in violation of REST. But I don't receive those emails anymore. That's not to say that that's not going on in some fashion, but the CFPB, while the CFPB was changing, was also dealing with an industry, our industry, which has a much greater eye on compliance. And so when you combine those things, we may see the regulatory environment change. It'll probably shift to a more consumer friendly situation. But once again, the companies, the lenders that are in our industry are much more aware of what they need to do to not run afoul of rules and regulations. And so, like I said, yes, we're going to see some changes, but I don't think we should be afraid of them. I hope that the educational process changes or continues, I should say. I hope that the CFPB remembers that it is dealing with an industry that is trying to help the consumer. And so it's not quite the situation that we had 8 or 10 years ago with Cordray, regardless of who is in charge of the CFPB going forward. And there are plenty of other industries for the CFPB to look at in terms of regulation and enforcement actions and so forth. Once again, that's not to say that mortgage banking shouldn't not be regulated and shouldn't be looked at, but there are other components that the CFPB can focus on, because frankly, I don't think as an industry, we're not broken and we're not doing the things we were doing years ago. So yeah, we'll see some changes, but hopefully not too bad.
One of the things that is a little broken, I think, just in general with housing in America is the inventory issue. Just no matter where you live, I live just outside Cleveland, Ohio. You see a for sale sign in a front yard, it's gone like in a week. And these houses are, I'm starting to look at buying a house, and it's just, I'm not going to be able to do that for a couple months. I don't even want to look, because anything I look at that I like is gone in a week. So, I think there's different things that play into that, but part of it is I think there's not enough new homes in America. Leads me into what I want to ask you about. It's just new construction in general. Um, I think there's a huge demand and a need for new housing stock to kind of be put out on the market to replace the houses that are knocked down and turned into other things and are falling apart every year. And yet there are some serious impediments to the construction lending industry. The cost of, vital raw materials like lumber, the lack of skilled laborers, the lack of buildable lots. It's one of the real interesting things that is very much a part of our industry and housing in general that seems like it's not talked about enough. What are your thoughts on that issue?
Well, if you go back, and you're right, we've been talking about inventory and we've been talking about skilled labor and expenses and so forth for a number of years now. If you go back to, um, a few decades ago, there was home ownership goal, whether it was 65 or 70%, or, people will say, well, everybody should own a home. And when you talk to people in the industry, no, not everybody should own a home. Obviously, some people don't want to own a home. They like the flexibility of renting. They may rent for other reasons. They don't necessarily want to own a home. They may not have the credit to own a home. And we don't want to give a loan to somebody who doesn't have the credit to make those payments, because that just leads to problems down the road. So you've had these lofty goals from the federal government and from politicians to say, a chicken in every pot and everybody should have a house. Well, the big issue, and I think a lot of people on this call know that what happens is by the time that filters down to the state level or the county level or the city or town level, and zoning ordinances, for example, or people saying, well, that's not in my backyard. I bought this house 10 years ago and I don't want I don't want them building a 30 condo complex next door, not in my backyard. And so you can have these goals from the federal government or the Biden administration, and we can certainly expect to see a lot out of the Biden administration in terms of home ownership and minority ownership and first-time home buyers, which are good things. But to your point, can they, even if interest rates were zero, if they can't find a house because there's no inventory, then it doesn't do any good. And it doesn't do any good if interest rates are zero and the federal government has all kinds of neat first-time homebuyer programs, and there are down payment assistance programs from here to Timbuktu. But if there's no inventory, if there's no homes to buy in desirable areas, then you run into a problem. And so there's a disconnect there. And I don't think that the Biden administration will necessarily do much in terms of houses for sale in your neighborhood. They can't really do much there. They can promote home ownership. They can foster an environment where mortgage documents are in different languages. They can do some things that can help the process. But once again, if there's nothing to buy in the neighborhood or in a good school district, or you've got a 35-year-old who wants to live near their 75-year-old parents, but there aren't any houses for sale, the Biden administration can't change that. So it comes down to builders, land, infrastructure. There are some creative solutions out there. I continue to hear stories about, there was a Macy's and a Sears mall a few miles away, and now nobody's going to it, and Sears is gone, Macy's or Pennies or whatever is gone. And so let's turn that into affordable housing units or condos or whatever it might be. There's some of that going on. So, but it takes years to do that. It it takes quite a while. So the federal government might talk about some pretty neat goals in terms of home ownership, but by the time it gets into the community, it can really get bogged down. And by the time you introduce immigration policy and workers and the cost of nails and how long it takes to get a washer and dryer through the supply chain and so forth, that it's a real problem that, like I say, I think we'll be talking about. We could be on this call, 4 years from now, talking about the same issue.
Yeah, no, absolutely. And it seems like we've been talking about it for 5 years. So be interesting to see what happens. My fear is just, with the pandemic and everything, it seems like a lot of times housing issues just get left in the lurch. They never make their way to the top of the politicians' priority lists. And I just think we're at a point with the inventory, affordable housing, some other issues in our industry where we're getting close to the point where if nothing is done, because to your point, it takes time, then it could have some pretty far-reaching negative impacts. So,
Yeah, I think I think there are some good things. The big topic. We're need to talk about what's happened this week or over the last couple of weeks. And the big news yesterday was with regard to Fannie Mae and Freddie Mac and the dividend sweep and so forth. And I think we are seeing some good things with regard to the mortgage industry itself. The news out of Fannie Mae and Freddie Mac and the FHA with regard to for extending purchase issues in terms of forbearance, but also that dividend sweep really gave a signal to us, and we can talk about housing inventory and so forth. And there's not a lot of that people in the mortgage industry can do, but people in our industry certainly like seeing some uncertainty removed. And the news that came out yesterday, yeah, there's some flies in the ointment. In fact, in my commentary tomorrow, I have some issues that people have written to me about, but it's nice to see some certainty come out of Fannie Mae and Freddie Mac. And
is
sorry,
that
there's
Myrtle?
a
Is that
scratching going on in the background. It's Myrtle.
somebody on LinkedIn proposed Myrtle for the head of the FHFA? So,
People need to focus on helping borrowers instead of writing about the damn cat. No, she's a good cat for the most part. Anyway, so there's some good things I think we'll hope to see. I hope to see out of Fannie Mae and Freddie Mac and FHA. But in terms of inventory issues, it's a tough situation. Good luck finding a house this spring.
don't remind me. Rich Swerbinski with the Mortgage Collaborative here with Rob Krisman for the rundown with Rob and Rich. We got about 5 minutes left, and want to just remind everyone that we're looking for a sponsor for this show, which has got a very quickly growing registration list, because primarily we want to incorporate a third person into these discussions. So you don't have to just listen to me and Rob ramble on every other Friday, which is what we did at 12 Days, and it worked really good with Tracy King Donadio from Partners Credit. So if anybody's interested in that, reach out to myself or Tom Gallucci. So a couple things I want to hit on with you, Rob, before we go. Just M&A, a big one with GR, guaranteed rate, buying Stearns. That's a big time acquisition. What's your just general sense of the M&A climate? I go back 2 winters ago when it was bleak, like everybody wanted to sell and there were no buyers. Now everybody wants to buy, there's no sellers. How do you see M&A playing out in 2021?
I think it'll shift. I mean, you can't get. It would be difficult to find an environment where there are fewer transactions than there were in 2020. And sure, some branches moved, and obviously loan officers moved, and there was a little bit of M&A, but you're right. There's an imbalance. Either everybody wants to sell, or nobody wants to sell, or everybody wants to buy, or nobody wants to buy. I think that the second half of 2020 and in general 2020, it was a rough first quarter, first half for a lot of companies, but they've really rebounded. And in general, the owners of companies, they like their P&Ls, and they say they see their P&Ls continuing for a while. And if you go out and try to find a buyer for that company, maybe the owner's 60 or 65 or 70 or 90 or however old they might be, they don't see the value being offered by buyers that they think the company is worth based on the cash flow. Well, we all know that at some point volumes will slow down, margins will start to compress. Uh, the question is, can you cut overhead if that starts to happen, or can you adjust your margins? And I think the P&Ls will be more normal in 2020, and I think that contributes to an more active buying and selling of mortgages. So I see that M&A picture changing this year, especially versus 2020.
IPOs, madness, really. We got United Wholesale coming up soon through a SPAC, Rocket, obviously, and a couple others went last year. Home Point announces this week that's the direction they're going. Loan Depot, I think, reiterates that's the direction they're going here in the first quarter. Thoughts on, so you look at just a lot of massive independent mortgage banking companies going public, raising lots of money, obviously, to grow and scale their business and scale new technology. We could be looking at a situation in a couple of years where the IMB market share already, I think, at its highest level ever, is going to be potentially, if the big banks don't really get back in the mortgage at very high levels, to the point where my fear is that, you have a new CFPB come in. They see so much of from a percentage standpoint of the overall volume coming from independent mortgage banks are not regulated the same as financial institutions, and some of the more far-reaching regulatory and compliance impact on the whole industry. What say you on those fears?
Yeah, I think that it is a fear. But if you're an independent mortgage bank, you're still going to go after market share. You're still going to price to get the business. You're still going to staff up to get that business. And if the big banks want to continue to withdraw, that's up to them. I'm still going to run my company to try to be profitable and to try to go after market share and try to add branches, especially if I have loan officers or branches come to me and say, hey, I really want to work for you. I'm not going to turn them away because the CFPB or some other regulator says, oh, the independent mortgage banker market share is getting too big. Scale it back. Now, if there are handcuffs or roadblocks, or I should say, speed bumps put in my way in terms of capital required, if I'm a servicer, if I'm an independent servicer, and I'm required to have so much capital, we could see changes. We could see tweaks like that in the coming years, because you do want strong hands dealing with servicing and dealing with origination. But for right now, once again, the independent mortgage banks are out there. They're doing it right. For them, it is the only game in town is residential lending. They don't have car loans. They don't have credit cards. They don't have trust services. They don't have wealth management that the big banks do. And so their focus is on mortgage banking, and they're going to continue to try to grow. And as I said, if the big banks want to give that up, give it to the independent mortgage banks, so be it. And the regulatory environment and the capital requirements may change, but for now, full speed ahead. If I'm an independent mortgage bank, I'm going to be going after business.
Absolutely. So running out of time. You're not dry January? You a dry January guy?
No.
I thought I saw you with the cocktail. That's why, so.
No, I made a joke in my commentary the other day about, all the money I'm saving on dry January. I can go out and buy some great edibles.
That's why, yeah, right. Why I asked, right? Yeah.
And I got some good comments about that, but no, everything in moderation, right?
I think it's hysterical how alcohol sales have just gone through the roof during the quarantine. It gives me faith in America.
Right. Yeah,
We rally together
when you wake up and you're thinking, oh, what am I going to drink tonight? Should it be a margarita night, or should I go with wine, or
it forced me to diversify, right? Just being home every night, not driving anywhere, right? Any parting words for the listeners here as we get set to wrap up our maiden voyage on the rundown?
Yeah, I think this is, you've heard me say this for quite a while, but I continue to see people in our industry helping borrowers day after day, week after week, month after month, regardless of what happens with politics, regardless of what happens with Fannie Mae and Freddie Mac. They are out there helping their borrowers in a compliant way. and companies are continuing to do that as well. And I think it's important to keep your eye on the horizon and talk, be cognizant of the issues that you and I have talked about on this call. But it's also important just to return phone calls and help borrowers. And that's what this industry is all about. So no, just keep up the good work. That's my parting message. Keep it up.
Awesome. Good stuff, Rob. Always enjoy the conversation. We'll be back same time, same place on Friday, January 29th at 3 p.m. Eastern for the next edition of this. And we're doing stuff all week, every week on TMC Connect. We're resuscitating. We have 7 different working groups of industry professionals, a lot of topic specific stuff that we're doing. So go to mortgagecollaborative.com and click on our member event calendar. You can see all the different things that we're doing for our members there. So, but I want to thank everybody. At one point, well over 100 of you on live. We also turn these into a podcast and upload them to our YouTube channel. So a lot of people view them that way after the fact. We'll continue to do that as well. But I want to thank everybody for joining us. And Rob, thanks again for doing this with us.
You bet.
Have a great weekend, everyone. Take care. Go Browns.